We're going to give folks here a minute to join. Try to figure out how to work through some of the limitations that are in Facebook. I don't know. Stuff that I haven't really delved into that much. Anyway, a lot to talk about this morning. Not the least of which, I'm not a big UFC guy. In fact, last night was pretty much the first time I've watched one from start to finish, if you don't include the probably hour I fell asleep in the middle, which speaks nothing to the event and more so to the fact that it's probably because I'm getting old. But anyway, that was yes, Eric. Anyway, that was I don't know if you watched it or you're a UFC enjoyer or not. Boy, that last fight was something else. And it's interesting. I mean, my kids watch it more so than me, and so I didn't know anything about anything. It's sort of like March Madness. I'm not a college basketball fan, so I basically just pick teams based on if I've ever heard of them before, what their record is, and whether or not I have an aversion to them. And I just had a feel when I looked at the two guys in the final fight. Sometimes I just, believe simplicity is the key to stuff. I'm like, well, this guy's bigger and he's more experienced. I think that he might surprise you. And you're like, oh, no, you're crazy. And then in the first round, I mean, the defending champ, clearly is incredibly skilled. And it really looked like the challenger was Gathy or something like that, was going to get tired fast, was sort of showing his age. But once he got his second wind, boy, he beat the heck out of the Matador and won. I think that there's probably a lesson to be learned there. I think, and I don't know these two guys from Adam, but I do kind of know about people and, sort of the build up and listening to both of them talk. And I don't know. I think that if I oversimplified it, I'd say that the defending champ was fighting for sort of notoriety, and the challenger was sort of fighting for his life and fighting for legacy or whatever. And, I don't know, I've said it a million times, hard work, kind of nothing trumps, no pun intended, hard work. And I think that that's what we saw last night. Anyway, we got about 2 minutes to data. Not that we have anything crazy here, just New York Fed, which of all the Feds, not my favorite, but generally I like these reports. So I think I've stalled enough as I see some folks getting on to just talk about what happened overnight and really over the weekend and really since almost Friday, I guess. To be clear, best I could tell, if you read into all the language being used and I think a lot of the qualifiers and caveats, we did not reach a peace agreement. Rather, it was an extension of Jenna hates the lighting in here. It's because I'm looking at a view. All right, I'll. How about we just have a better setup? I don't know. Buy me a better setup, I guess, is the answer. Here's what I'm going to do. I'm going to shut that. No, I'm kidding about buying a better setup. I'm shutting the shade over there. So I don't know that we actually reached a peace deal. Okay. And so why are bonds not screaming? There's a couple of reasons for that. And by the way, they're off their best levels, 10, 11 o'clock last night We were at like 442 on 10s. We're at 445 now. This should be better, by the way. And so this deal is going to be signed Friday. Now, if unless you've been under a rock, how many times during a ceasefire has there been fire, so on and so forth? So I think one of the reasons for the market to be skeptical a little bit or conservative in trading this peace deal is we've got a long way to go before it's signed. And so that's number one. Number two is it's an extension of the ceasefire. Now, albeit that extension comes with the opening of the strait, which, by the way, let's not bullshit each other on that either. I don't know that the market particularly cares about whether there's fire or no fire. All they care about is the strait and oil, right? So, if we had a deal without the strait reopening, I don't think anybody would care. And if we had no deal and the strait reopened, I think everybody would care. And so being that we've got a little bit of both, or at least the promise of a little bit of both, we're a bit more optimistic. But, in like last night, the MBS live chat, I mean, folks are already talking about flipping loans from lenders and breaking locks and margin calls. I gotta say, I just hate that talk. Flipping a lock on a loan that's closing imminently does so much damage to the lender. And maybe I'm saying this as a lender, that to not even allow the news to marinate, to not even see a rate sheet before folks start talking about stuff like that, just to me is I don't know what word I want to use. I'll say diabolical is probably the most tame word I can use. It's short-sighted, and I'll tell you why. If you hurt your lenders enough, ultimately it'll hurt you. Maybe not today, and maybe not even tomorrow. But the less money that they have to push through the rate sheet at large, the more conservative they're forced to price because of churning and runoff and playing games with float downs and renegotiations that are frivolous. And by the way, here's the thing. I don't know that you have to do any of that if you just tune in and watch this every morning. Because what did I say early last week? Time to lock, rates got worse. Then what did I say late last week? Time to float, rates are better. I'm not always right, but if we continue to, sort of work together and go through this and explore the markets together, I think what you'll find is that the tea leaves are a little bit easier to read than one might suspect. 8:30 data, New York Fed 5.7 versus an expected 14 and a last month of 19.6. I think most people would argue that this is like a D level data point. I'd argue it's more like a B minus data point. Regardless, not a great number for the economy, and therefore a good number for bonds. Let me share the economic calendar here. Fair amount of data overnight. By the way, generally not bond friendly, but definitely mixed. Unemployment rate up here, that's good. Price index, big drop month over month here. I assume that's Denmark. That's really good for rates. But then again, another miss in price here, good for rates. But then you get over here in India, and that's no bueno. Producer prices, again, in China, good for rates. Good, or better. Good or on the screws, doesn't hurt. So net, I'd say better data for rates. If we look at the markets, as you might imagine, stocks and bonds are up pretty much across the board. Nikkei almost up 5%, by the way, overnight. Europe did well. Onshore futures are indicating about a point to 2 points better. Volatility way down. The VIX down to about 16 and change. I want to say the lowest we've gotten recently, 14-ish. Something like that. Yeah, maybe not even, by the way. What kind of, let's look at a 1 month. Yeah, I was about right. 15 and change. Here we got, yeah. So 15 and change is the best we've seen in a month. And so therefore, we're approaching those levels, and here, no shock. And I've been talking a lot about the cost of oil, and talking about if we can get it to 60 or 70, this talk about inflation is going to go away. We're still nowhere near it, but down 5%, a really, really good start. Hopefully you're sitting on platinum and silver. You did well overnight, and the dollar weaker versus most other currency. Bitcoin back to 66. So what's some of the talk? CNBC. I'll just sort of read some exact words so you kind of get where I was going. I haven't read this article, but here are some of their bullet points. U.S. and Iran agreed to a memorandum of understanding on Sunday to end the war after nearly 4 months. Markets are celebrating to end a war that triggered a global economic downturn that lasted nearly 4 months. No deal has yet to be signed, though the sides have agreed to a memorandum of understanding and stood down militarily. The critical Strait of Hormuz is to be reopened as part of the deal, according to President Trump. And the big thing is, when you were seeing some of the rhetoric out of both sides over the last month or so, as we've approached this deal, it's been deal's done, no, it's not done. Deal's almost done, almost is a big word. Now you're getting language out of both sides that really kind of corroborate each other. So the president, I just gave you that quote. And so first thing CNBC does is, did Iran sign a peace deal? And will be signed Friday in Geneva. So make no mistake about it. This is the closest we've been in 4 months. A permanent and immediate end to the war has been declared on all fronts. So it's almost more important than that talk out of Iran than we're getting it out of the White House. Because at the end of the day, it's what I've said. And listen, I was wrong. I thought that this was going to last a day, a week, a month. And mostly because I thought that Iran had no chance. And I thought, and when I say I thought, I know that our president is a deal maker, if nothing else. So long story short is, at the end of the day, this has always been a means to an end. And that end was to make a deal. And a deal that ultimately is slightly more favorable to the United States. And that's what all of this has been. And I say this in the least political way possible. And it's ridiculous that someone who opines on the economy and whose job is predominantly, if not exclusively, predicated on economic events has to qualify these statements. But most of the deals that the United States had with foreign states were not good deals for the United States, full stop. Does that mean that that was, they were categorically terrible? To whatever extent, and I'm a guy that sees the forest through the trees, right? So if the bar is, well, it keeps the peace with a bunch of folks and it doesn't make us look like the bad guys and we're going to win the long game. Hey, I'm all about losing battles to win the war. Got it. But boy, some of these deals were bad. The trade imbalances, so on and so forth. And, if you go back to, probably a market minute that I did, gosh, whatever it is now, 16 months ago, about the tariffs and all the consternation about the tariffs. I guess it was 16 months ago. Was it even more than that? I don't know. Whenever the tariffs started, I feel like it was like February 25. Anyway, I've been resolute in saying that, sure, there's, you have to trade, you have to be mindful of the near-term consequences of all these decisions and actions, but the long-run implications are really where we have to focus. And, I think that so far that's all been proven to be right. And so where do we go from here, both today, this week, and in the future? Well, I'm going to really sort of double down on what I was saying last week, which is at the end of the day, once the concern around conflict-based inflation subsides, we're going to come back to the economic data. And for a 30, 45, 60-day period, maybe even a little bit more, the economic data was not bond friendly. For the last week, maybe two, it has become much more so. And if one were to extrapolate the implications of falling oil prices into inflation and combine that with a weakening economy, the threat of stagflation goes away. And I've mentioned on several occasions that ultimately, to me, while albeit maybe a small percentage, is the biggest threat we have to our economy. It's not inflation and it's not jobs, it's stagflation. And I can opine on that thought another time, but really the reason why nothing that happens economically concerns me is the Fed, period. They can't mind their own business. So if we show too much weakness, they're going to step in. And if we show too much strength, they're going to step in. And boy, do I wish. And listen, those horses have been out of the barn for decades. If they would just allow for price discovery, sort of that short-term pain that maybe I'm willing to accept, would result in a much, much smoother ultimate landscape. And the unintended consequences of all of this, this meddling, and that is what it is, right? Maybe the booms wouldn't be as big and the busts wouldn't be as bad. And I'm not certain that would be such a terrible thing. But anyway, there was a point to my rant, but maybe the rant is the point to my rant. We've got some 10 o'clock data, nothing that's going to really, be crazy. Interested in tomorrow's ADP, that's for sure. For me, the real highlight on Wednesday is going to be retail sales. For a couple different reasons. I really want to see what the summer consumer is doing. I really want to see, if there's any sort of inflation fatigue in the retail consumer or not. But I think that the biggest reason I want to see this retail sales number really won't make itself known for another month or two, which is that if this is the last, and June will be a mixed report, and that's why I say it might take another month. If this is the last conflict embattled number, right? Oil, gas impacted number. How is May going to comp to June, going to comp to July if we do see prices recede a bit? Not so stupid to think that things happen that quickly, but sometimes they do, especially if you have a starved consumer or a starved business or sector. But then again, the end of the day, I'm sure most folks think 2 o'clock and the Fed, which is a presser, and it'll be Marsh's first. Going to be very interesting, no doubt. Get your popcorn out. I'm sure we're going to do maybe both an 8:30 and a 2 o'clock, maybe do a little bit of a live reaction to 2. This is going to be an interesting one, right? I think, and I called this last week, is I think that they want a done deal by this meeting, and it's not. But unless we get any contradictory language out of the Middle East in the next 48 or so hours, certainly I think the operating assumption at 2 o'clock on Wednesday is going to be a deal is done. I wonder how much the Fed backs off the hawkishness in the face of that. Claims in Philly Fed Thursday, Friday holiday, Juneteenth. And then next week, nothing Monday. So you really almost have a 4-day weekend. We'll talk about how to kind of trade that. ADP Tuesday, not a heck of a lot Wednesday. And then we have last revision of Q1 GDP. And then the PCEs that go with that. And that to me is really the highlight of the week. As we wind down, if you have any questions, post them here. But I go back to kind of where we started. Bond reaction, somewhat muted. 10's at 445. The belly is maybe 5-6 ticks better. 6s are looking at a 102 handle. 6.5s maybe finally back above that 104 handle. For me, I think that this is sort of how I play this today, tomorrow, Wednesday morning. Cautious optimism, right? I think that I would want to be measured in my response. We're kind of flat, 5s and 5.5s. We're long, We're long 4s and 4.5s, and we're long 6s, and we're very long 6.5s. I see myself letting this sit a little bit this morning and taking a little bit of coverage, taking some of that profit off the table. Listen, the next 48 hours are, and for that matter, the next 5 days or whatever, I assume this deal would get signed overnight. So, it's less Friday and more Thursday almost. So, long story short, we have some potentially volatile days ahead of us. And when I purely look at a chart, do I think that 6s on the news of the end of this conflict? What would be the motivation for 6s to break through February 13th? I don't really see it, right? Let's keep this real for a second. What would be the motivation for 6.5s to push through April? And I don't know how real that was, just to digress for a second. So we saw on an underlying coupon basis, 6s catch a huge bid, right? But what we saw was the spec prices get eliminated. So that was a little bit of a head fake. 6.5s were never really trading as strong as the screen would indicate. So I put the 6.5s really in the same bucket. So now the question becomes, if I look at best 6-month levels, call it 1.5 on 5s better than where they are right now. On 4.5s, call it 3 points better. Where are our opportunities? I'm going to say that there's maybe 0.5 point, so an 1/8 in rate, maybe 1/4 in rate opportunity on a 5.5 coupon. Maybe you have 1/4 point rate opportunity on 5s. I think that if you've learned anything over these months, that's not so much rates going down, because I'm talking about how 6.25 and above is going to really stay the same. That's not, sort of rates going down per se. It's making points go down, price go down on lower rates. If you're still originating in the 6.25 certainly and above, but even maybe 5.75 and above markets. I don't know that what's going on this week is going to create tremendous opportunity. And in that case, I'm much more conservative around this. You're already at pretty good levels. In some ways, my near-term lock bias has actually gone up since Friday because we've caught this bid. If I do a 2-day chart on fives, or let me do a 2-day chart on 5.5s, okay? That's sort of a lock chart, right? We're 30, 35 basis points better than the worst levels. If I push out, that's a lock chart. I mean, heck, if I look at the 1 month, that is a lock chart. We are essentially back to early May levels, right? So for June closings, to me, today's a day of, if I've taken a chance, if I still have a bunch of floaters, there's a really strong case to be made for locking that up today. I think that where I am much more bullish on floating here is end of July, August closings. I think that the reason for it is, if I trust that this conflict is going to end, if I trust that that correlates to lower gas prices and oil prices, if I trust that that correlates to better inflation prints at some point, and if I trust that all of that correlates to a less hawkish Fed, a more patient Fed, we have a long way to go, right? We were pricing in rate cuts. We went to pricing in a rate hike. If we could just get to middle, if we could take that rate hike off the table, which is to me the most likely outcome. That's why I say I don't think the Fed's going to get dovish here. I think they're going to get less hawkish, or are likely to get less hawkish if this conflict is over. That's where you're probably looking at, 430 on 10. We've got maybe another 15 basis points on 10s of run here. And I think that that's most likely to hit in July. That's how I would play it. In total, much more optimistic about bonds. In the near term, still optimistic about bonds, but I feel like I've made enough money that I want to take a profit if I've been floating. But all of this is subject to change. I mean, who knows? I know that Israel has been problematic for the president in terms of trying to get this ceasefire and this truce to come to fruition. And if they do something crazy, who knows? If Palestine's volatile, if they do something crazy, and certainly Iran is volatile, and if they do something crazy. So, I take this day by day, but the closer we creep to the end of the conflict, it goes back to that, hey, fight the Fed mentality. If we're no longer fighting the pressure of oil prices, and if the president really wants to double down, and so the straits open and our barrel release is open, we could be looking at $65 a barrel. And I think that bond traders will front run that. So as always, thanks for joining live and watching on replay. A little bit of a longer one today, but a lot went down over the weekend, and I wanted to thoroughly examine that. Bulls and Bears make money, pigs get slaughtered. See you tomorrow. Choo-choo.